Welcome to the Commercial Know-How podcast, where mortgage brokers learn how to successfully launch, manage and grow a commercial finance business. I'm your host, Belinda Gibson. Join me as I draw on more than 25 years of property finance expertise to show you how to diversify beyond residential and build a growing business for all seasons. Don't forget to hit subscribe and visit commercialknowhow.com.au to download my free ebook to help you get started in commercial finance. Now, sit back and enjoy the episode. Hi, and welcome to Commercial Know-How. Today on the show, we are excited to have Kylie Donelly from TM Finance Group joining us today to talk about commercial lending and assisting with today's episode on Q&A. So Kylie is one of the brokers from my business, TM Finance Group, and she works out of our regional office in Victoria. And she's here to join in our Q&A and discuss commercial lending and some of the experiences that we have had. So thanks for joining us today, Kylie.
Well, thanks for having me, Belinda. Love a little Q&A.
Awesome. So we've got a few questions that have come in today via LinkedIn and Instagram. But yeah, there's some different ones that we've had previously, which is great.
Yeah. So do you want to jump straight into it?
Yep, sounds great.
Okay, the first one is from Women's Networking. How do you prepare a great submission?
Yeah, that is a really good question. God, we do like to think that all of our submissions are great, but it's more about following the whole 5 C's of credit. So when we are writing a credit memo, which is what we refer to our document, other brokers might call it an information memorandum, but we're just putting together a bit of a document around who our client is, who the borrowing entity is, and what they're hoping to achieve, so that by the time the bank reads that document, they know exactly who the borrowing entity is, what funding they need, what they're doing and why, but more importantly, how they get paid back. So we do a lot of financial analysis in there. We also show their capacity to repay or demonstrate they can meet a serviceability requirement, and we'll talk about their security position, and then we'll go through a bit of an exit strategy so the bank will know exactly how the debt's going to be repaid, what the security is that we're taking, what the market value is and the lending value. And that way, when we give that document to a bank, we can quickly get a term sheet back. So if the bank has appetite to support, what interest rate and fees we can expect, and also a time frame on, how long it's going to take. But we want their buy-in and we want to give them as much information as possible. And we generally will give that to, 3 or 4 banks. So then we give the client a pricing submission back as well, so that we can recommend one bank over another as an example. But it's good to disclose a lot of that information up front to the lender so they know exactly what our client's scenario is. Do you think that's a fair sort of summary, Kylie?
Yep, I feel like that's a fair summary. And I also feel like as well, when you give a bit of background around who the client is and what the total exposures are and things like that, it places it with the correct banker. So then you are making sure the person that's reading the information understands, has experience, can ask questions perhaps you haven't thought of. So then overall you're getting the correct information, because there's nothing worse than sending out like a pretty generic request and then the person thinking, I can do this, and then not realising that perhaps it's specialised or out of their scope, and then the entire transaction changes. So detailed up front is important. Yeah.
I could remember when I was a banker at Westpac and I got an email from a broker and it says, hey, client wants to buy X, here's his financials. And I'm like, what am I meant to do with this? I don't know anything about them. So then it does waste a lot of your time, because you've got to go back and almost interview the broker around what they're actually wanting. So if we do that credit memo up front, we have a much better experience for the banker and for our client as well.
Yeah.
Yeah.
Okay. So then the second question that we've received is sort of a two-part. How long does a commercial application take? / how long does it take to get an approval?
Yep. So this answer is not a short answer. So there's two parts to this. So we've got the good and the bad. So we've also got SME applications. So in that, that small business under $1 million lending. And then we've got commercial, which can take a lot longer. So let's talk about the good first of all. So we've had lots of really good experiences and quick approvals for small purchases. So let's say, someone's buying an office block for $800,000. If they're going to own or occupy that premise, we've had some really good experiences with one of the major banks where we can give them full BAS, and when it's a purchase, we don't need a valuation. So we can really quickly get an approval through, and we can do that with a couple of the major banks. And the turnaround time can be under 5 days, particularly if we don't need a valuation. And that can be the sticking point, because when we're going for a formal approval, we still need the valuation. And I've stressed a few times on the show that the commercial valuation can take anywhere from 14 days to 21 days. So call that 2 weeks or 3 weeks, but that needs to be a part of your finance clause and taken into consideration. On the longer end side, we recently had an application that was for $5 million. We started that process in October, from when we first met with the clients to understand what their borrowing needs were through to when they settled. Now, that one took a lot longer because, one, it was a larger application. Getting the required information took a lot longer, which then delayed the submission writing process. It delayed getting the valuation underway. And we also had some issues with the property where we needed some soil testing done, which also took its time. So we also had to manage the client's expectation from not only our purchaser, but also the vendor who was selling the property. But because both were commercial business owners, they did understand the process. It wasn't their first rodeo, if you like. So they knew it was going to take time, but because the communication was there, they always had a timeline in place. This is the stage that we're up to. This is what we're waiting for. This is when we're expecting an outcome. So everyone was on the same page. If the client is an existing commercial customer and they have a dedicated relationship manager, the commercial application can be much quicker because there's already an existing relationship with the banker, with the broker and the client. So we find that when we're sending, an additional deal to an existing commercial banker at Westpac or an existing commercial banker at ANZ, we're having really good experiences because they know the client, they know what they're looking for, and they're familiar with their financials. But then on the flip side, if we've got a new commercial client, they can take a little bit longer just to make sure that we're putting them in front of the right banker. You've probably got more that you can add there, Kylie, because we've all had, different experiences with smaller lends and larger lends, construction loans, for example.
Yeah. I think that it really is dependent on the segment as well. So I think that in the SME space, like you said, we can get a quick approval and it's an easy process because we are ticking boxes. So it's probably a little bit more like a residential assessment where you're like, yep, I hit all those benchmarks, in we go, provide what you need. But then exactly like you said, I think it's very banker dependent and their experience, and it depends on the complexity of the security, income streams, etc. So It sort of feeds back into the previous question, what's a great submission? The more you have up front, and if you're raising any possible exceptions that may be required, then you can address them up front, which makes everybody a bit more comfortable and speeds up the process. But I will say that, it's sort of like how long is a piece of string. If it isn't a box ticking cookie cutter deal, it will really just depend on so many variables. So that's when you really need to manage expectations from all parties.
Yeah, I agree. So the shorter answer is, if it's 5 days for a smaller tick and flick application that doesn't need a val, right through to, 4-week minimum, anywhere through to 2 months, depending on the evaluation and any other complexities that are attached to the file. But it's definitely, it's not a quick process.
Yeah. Okay, so the next question is from Sharon, and she has asked, how do commissions work?
Yep. So unfortunately, you will get paid less than in the resi space. So as a rule of thumb, the upfront on commercial and business lending is 0.5%. So $1 million is $5,000. Now, that will also depend on your agreement with your aggregator, but as a rule of thumb, it is 0.5 plus GST. And of course, you're going to get trail as well. So that on a better note here, trail is higher. So as a rule of thumb, it's about 0.25% on the balance owing. There's not a lot of offset in the commercial or small business lending, so you don't have to worry about things like a net of offset. Clawback does still apply, but that is going to be a very much loan term dependent, application fee dependent, and generally the clawback period can be shorter than in the resi space, but again, it can be banker dependent as well. But if you work on those rules of thumbs, 0.5 as an upfront and 0.25 as trail. Now, in the over 1 million space, we are aligning interest rates to BBSY. And so to get a fair interest rate, your banker is probably most likely going to have to do what we call a pricing submission. You won't have any control over that. But what they're trying to do is get a fair interest rate for your client, but they also have a net profit margin that they need to meet in that space. And so sometimes that does mean that your upfront fee can be negotiated. So don't be alarmed if a banker comes back to you and says, what sort of upfront are you expecting from this deal? So if you're looking for a 0.5, it can result in the client having a higher application fee. And so the banker might come back and say, okay, well, if we need a rate of X, so, let's just pull the rabbit out of the hat and say, well, if we need a rate of 6.5, a 0.3 upfront is going to make that work. But if we're looking for a 0.5, well, then, we're going to have to meet this interest rate hurdle and the resultant rate is going to be X. So you do see that quite commonly, but it is up to you whether, you want to accept that or not. But if you've got a rule of thumb and you say, no, I need to earn this off this transaction, well, then, it is going to impact the client's interest rate because it's priced differently. We're talking about wholesale rates plus margins, sometimes line fees, and pricing is calculated a little bit differently. Have you got more you can add in there, Kylie?
No, I'd say, that relates to term lending against security, where it's different for equipment finance and short-term lending through non-majors, I would say. So something maybe to note if you're doing an entire transaction where you might be asking for an overdraft for working capital, etc. It's not necessarily based on the entire transaction amount. It's based on the term loans.
Yeah, and you can pretty much expect zero for an overdraft because, they're pretty much not going to be using their limit all the time. And if they are, maybe an overdraft's not the right product for them.
Mm.
Yeah, and then we should have one more question.
Right. And it's from Mark, and they've asked, how do fees work in the commercial space?
Oh, yeah, banks love fees, don't they? Yeah. So we've got some common ones, and then we'll have some not so common ones. So you can expect an application, or what we would refer to as an establishment fee. So that's where we've got that sort of that 0.5 upfront. Now, that can vary from lender to lender. So in the commercial space, you will expect it to be at a minimum of a 0.5. It can go upwards to, sort of that 1.5%, depending on whether it is securitized or whether we're talking about construction lending. And then in the SME space, you might see some lower interest rates where banks might have a promotion where there is no application fee, or they might have a line in the sand where they say, well, our application fee is $800 as an example. And then your client will pay the valuation fee. It's not very common that a bank will waive this, but some do, and others will have some promotions where the client might pay up front, but then they'll reimburse them at the back end at settlement. They'll have a monthly service fee. Now, these also vary, don't they, Kylie?
Yes, they do.
$20, $30, or sometimes $187 a quarter. So bank dependent again, but probably the lowest I think we ever see in the monthly service fee is probably about $20.
Yep.
A month. It's rare that they will be waived. They are a little bit annoying, but you will see the higher end fees there. In commercial, you can also expect to see a line service fee, particularly if they've got a line of credit or a construction loan in place. So can you remember how these ones work, Kylie?
Yes, I can, because I've had to explain that so many times in my previous role. So, yeah, the line fee is charged out either monthly or quarterly, and that is based on a percentage. So think about it like another separate interest rate. So it gets calculated on the limit of the loan, not on the balance. So even if you have a facility that is undrawn, which happens quite a lot with commercial accounts where they might have $1 million line of credit and it was not drawn, but you are still paying for the privilege of having access to that money. And I'm not sure what a line fee would sit around these days, maybe like 1.5, 1.2-ish, when I remember back when they first were introducing them, which is so well ago, and we used to think, well, 0.25 is so high. And yeah, so you are paying for the provision of that money, whether you use it or not, and it's charged as a fee instead of a percentage.
Yeah, and it's normally aligned to how the client, how the bank, assesses the risk of the client. So we will generally see a higher line service fee for those larger end construction deals. But if a client's got a line of credit, but they've got really strong financials, they might have a lower line fee, but it normally aligns to risk. And then the other ones that we would see might be, just smaller fees like rollover fees, for example. So if you've got a shorter loan term in the commercial space, it might be 2 or 3 years just to get the interest rate competitive. Some banks will charge you to roll that facility over and extend the loan term out once we get to the maturity. But again, that may be bank dependent as well. Do you think we've covered sort of everything there?
Yes, I feel like that's majority of the bank fees. I've seen a couple of times if you're borrowing in the capacity of the trust and the trust needs to be vetted, sometimes there's additional fees for that. But yeah, pretty much say we've covered off the majority of the main fees. And if there is additional fees or particular fees from that lender, and you would like to think when you've put in your term sheet that they're coming back to you and saying this is the scope and these are the applicable fees. So there's no surprises.
Yeah, I agree. But as long as you cover off those main ones, I think when you're sending your pricing back to the client around the val fee, the application fee and the monthly fee, you're going to get the lion's share of them captured anyway.
Yeah, that's right.
Yeah, awesome. So that's the last question. All done.
Excellent.
Fantastic. So that brings us to the end of today's episode and the end of season 1. So on a personal note, I'm heading overseas for the next few weeks, mainly to complete the London Marathon, which I'm both excited and very nervous about. But in season 2, we will be back in June and we'll have more to learn about. So we'll focus a little bit more on commissions, equipment finance, SME versus commercial, and we'll also be interviewing a client to talk to them about their experiences in commercial lending and also their experience across a number of major banks as well, just to name a few episodes to look forward to when we return in June. So special thanks to having you on the show again today, Kylie, and joining us on the final episode for Commercial Know-How.
Thanks for having me.
So once again, listeners, thanks for joining us on Commercial Know-How, where we explore the importance of building confidence, refining skills for commercial loans and empowering mortgage brokers to excel in a diversified business. And to find out more about Commercial Know-How, you can visit us on our website at commercialknowhow.com.au, where you can also download my free ebook, and don't forget to follow us on your favourite podcast player so that you don't miss an episode, and we will see you again soon. Thanks for listening to the Commercial Know-How podcast. Don't forget to visit commercialknowhow.com.au, where you can get in touch with me or download my free ebook to help you get started in the commercial lending space. If you enjoy the show, please hit subscribe so you don't miss an episode. See you soon.